Howard, so how are we doing this quarter as we are now past the big ones, but still got what, like 25% of companies left to report, something like that?
About 30%.
30,
Most
okay.
of them are retail, obviously. We had, as of this morning, we'll have more tonight, and it is a hectic week. We had a 280 issues report. 81% are beating, and they're not just beating by a penny, they're beating nicely. This quarter is still projected to be a tick under last quarter, which actually was the record. However, Q1, Q2, and to some degree Q3 right now, have been big positive surprises. So we could feasibly have another record. If not, we miss it by a tick. Still keeping you at that 21, 22 PE going forward, but the earnings have been going good. We've got a little bit less than half of the cash flow, and the cash flow is going very well also. So it's not just the operating or even the as reported GAAP numbers. The cash flow is coming in nicely. So it's supporting the market and the index if you believe on those forward PEs, which again, 21, 22, you are paying a lot.
So, Howard, what role are the buybacks playing here? I mean, we've seen some announcements. Is it getting pretty frothy again in terms of companies' willingness to scoop up their own shares? Are we back to normal?
On the actual expenditure side, we may get a record right now. We've got a little over 60% in there, and obviously Apple and Facebook, they're leading the pack on there. The record was $223 billion. We definitely have a good shot at there. So the expenditures are there. However, the impact is nowhere near there. Prices have gone up significantly. Options are, more of them are in the money, and it appears that employees, shock and dismay, are taking some of the money off the table, even if the options aren't expiring yet, and paying the taxes. So the companies are spending a lot of that money just to cover options. Okay, the number of reduction in share count has declined significantly. About 7.8% of the companies for this quarter, Q3, have significantly reduced their shares, compared to about 23% 2 years ago. Bottom line is, few companies are impacting their EPS. The options are eating out the money as well as the share price. So we're not seeing the EPS pick up. If they want to do that, they're going to have to significantly increase the expenditures on buybacks. And at this point, even with the 1% tax, which doesn't seem like it's going to do much damage to it because there's so much ingrained in here, we're not seeing the EPS impact, and we're not expecting to see it for several quarters. Again, because the prices of the stocks are so high, you're getting fewer shares.
So even though we're going to get like a nominal buyback number comparable to what we did in the past, the actual impact is not the same in terms of the actual, market cap weighted impact. Any idea what that should mean in terms of how these stocks trade, or how we think about the role of buybacks in some of these companies where that was a big story?
Yeah, especially the EPS increase. What that's going to mean going forward is earnings start to slow down the growth rate. We still have growth forward all the way into 2023, but the rate of growth is being reduced. We're not getting as much impact on there. The EPS typically can add a couple of percentage points. Again, 1 in 5 companies were doing it, significantly before COVID. Now they're not. So it's coming at a time when EPS growth is kind of low, okay, even though margins are high. So it definitely has the impact there. We could use that boost to justify these high PEs at this point, but it doesn't look like we're going to get it. Not at the levels they're spending now.
Howard, the overall earnings picture, when you combine the bottom line that is organic and the help from the buybacks, does this look like a market straining to live up to its valuation demands, or is it living up to the expectations of this post-COVID profitability bounce back?
I wouldn't say it's straining because there's so much optimism and buying in the market and expectation on sales, but it is historically high, very high at this point in time. We are paying considerably for the forward earnings. And if that optimism wanes, or we get some of the buying stops that come from coming in, or the cash flow, we're going to have to reevaluate the numbers, and it's going to pull back on there. I mean, the numbers are high no matter how you measure it. 21, 22 PE is significant. But partially, you can't get money anywhere else. And if you're not in it, you can't make it. You know, dividends, 2% is a nice yield. Go to the bank and you're getting nothing. Treasuries, as you've been saying, you know, we hit that 1.7 and it dropped down to the 158. So there's not a lot of places to go if you want income and capital gains.
Howard, in terms of the expectations from here, what do we learn? Is this going to mark some peak for the COVID-driven tech adoption and top line growth? What does that top line or bottom line trajectory look like from here?
Tech looks like it's still doing well. It has very high margins. Yes, there's a lot of difficulties with the supply side, especially on the chips, but they're managing to hold their earnings on there, and they're contributing. If you look at the market, IT is contributing the most to the, at least to the index, you know, the broad index, the 500, and it is expected to continue on there. The earnings, we'll see what happens on this holiday season, what's being bought, what's not, especially with shortages, but the margins are enormous. I might tell you that the historical operating margins for the S&P 500 is 8.1%. We are at 12.9%. More of the money on those sales are hitting the bottom line, and companies are able to control their costs. That's an enormous spread, 12.9% operating compared to an 8.1% historical. Even if we lose some of that, we're still making a lot of money and it's showing up in cash flow.
So even with all the supply chain concerns and inflation impact, the margin's still well above the historical standard.
At this point.
Interesting. Howard, great context as always. Thanks for being here.